Welcome to our platform for investor education. My name is S.G. Badrinath. I have been teaching and studying financial markets and equity markets for the last 30 years to students who are undergraduates or MBAs in both the United States and in India. Over this period of time, I have worn several hats. I have been an investor almost always. I have been a trader occasionally. I have been a consultant. I have managed money. I have been a scholar who writes papers that unfortunately for me, very few people actually get to read. At the moment, I hold the Canara Bank Chair of Finance at the Indian Institute of Management in Bangalore.
I write about financial markets, but from the point of view of the households. For 20 years, I have written in newspapers, magazines, some television shows, podcasts, radio, digital, social media, workshop, the works, to take my message of financial empowerment to the households. Many of these lessons I've managed to plug back into policy and regulation, but the one thing that my takeaway has been is that every household wants their money to do better, but they simply don't know how. And that's what we hope to crack with this series. I am Monica Hallan. I am consulting editor with Mint and the author of the best-selling book, Let's Talk Money.
Monica, we were talking about safety nets for individuals in terms of insurance, medical, health, emergency before they started thinking about investing towards wealth creation. But what, in your opinion, experience holds people back before they start participating in financial markets?
The biggest thing is that people think they need a large amount of money to come and hit the market with. I think they've seen too much of Wall Street movies to think that you need a large amount of money and you will take the speculative calls and you will come to the market with a pot of money. But actually it takes very little to start investing.
Yeah, there are in India the last couple of years these wonderful creations called systematic investment plans that I'm sure some of our audience is already familiar with.
Yes.
But SIPs let you contribute as little as 500 rupees a month into any investment vehicle of your choice, however risky or high risk or low risk it might be.
And SIP also matches with your income rhythm. You get money every month, you spend some, you save some, and that goes into your systematic plan.
And this could actually be one of those pieces of your invested account that we talked about a few episodes ago, if I'm not mistaken.
Absolutely. I mean, it's completely a part of that we start building our money box and start investing systematically into the market, but without getting into the speculative piece.
Yeah, but at the same time too, one hears people say things about markets not being trustworthy, about people gambling. Is there a sense that you have of how this works?
That's what the problem is, that they think of the stock market not as a rational place for investment. They think of it in a way that they will double or triple their money. It's like a roulette.
Going in and out quickly.
You are going in, you're going out. They're not looking at it as a vehicle for long-term wealth creation. And you know what those numbers look like. In India, when you do backtesting, you know what those long-term wealth creation numbers look like.
Over 10 and 20 and 30 years, equities have been the place to be.
And that is the story of a growing economy, that if you have a growing economy and if you have fairly deep markets and you're investing in the index or stocks or mutual funds, you have a fair chance of doing well with your money.
Yeah, but this gambling instinct that you talk about, I go back to a time too when I used to be a bit of a trader at some point. This was in the 1990s when, internet stocks were all the rage and everybody I knew was secretly hiding in their offices and trading stocks without telling anybody. And truth be told, I thought I did well at the time, but I actually made more of my money just by sitting on it for long periods of time and not by trading it. And I think people in India do this because they don't trust markets, but what is your sense for this? I mean,
I think they've not been handheld well into the stock market. They've not been shown the power of compounding, sitting, identifying good funds or just an index fund and just simply holding. There's been too much of glamour around markets. It's actually very boring. Good investing is boring investing. The day that people understand that, they will come into the market with reasonable expectations, not about doubling your money in a year, but a reasonable 14-15% on the Indian economy Long term is something you can actually target through an index fund.
Yeah, no, I recall, talking to an old Gujarati family friend at one point, and he said, everybody in India wants to make quick money. Show me somebody who's willing to make slow money, and that's the kind of investor that I will actually pay attention to. And I think that's partly the message.
That is the message, that markets are not a roulette machine, it's not a gambling den. It's a place you give your money equity exposure as a person who's not an entrepreneur. I mean, remember that an entrepreneur gets market risk through his enterprise.
Right. And the success or failure of the product.
Of that product. That's right. But as a salaried earner, you have no hope that you will get a multiplier in terms of wealth creation. So for you, you need an equity exposure. You're not playing the markets. Your money needs an equity exposure. That equity exposure will come through an index fund, mutual funds. That is the route.
What about your sense, the other thing I hear talking to people, and I'm preaching the equity story to, my friends, my neighbors, and everybody else. And I keep hearing about notions of scams in the marketplace and notions of trust in the marketplace. And that seems to be holding a lot of people back. And, at the same time, they're putting their money in gold and real estate, which are just...
So it's not a scam. So gold, to be fair, is not a scam. But when people buy gold, because it's physical, you can hold it, they are buying jewelry. And the minute you buy a trinket, you are giving 30% away for making charges. And gold it's a hedge against inflation.
So that same inflation that the FDs were not protecting you from.
Yeah, so you can have 10% of your portfolio in gold. But more than that, so gold as an asset class, you know that it doesn't throw off rent, interest, dividend. It will only give you a profit over the buying price and that's right. And then the long-term trend line for gold is just slightly higher than a fixed deposit. It's not that great. So either you're timing the market, you're knowing when to get in, get out. Most people don't do that. So that's really the problem with gold. We have too much.
But I think the idea there is partly the same as with real estate, right? That gold is something you can physically touch and feel, and you have a connection to.
Right, and also the other part of the story was that you didn't have these modern financial products. To be fair to people, they were choosing out of what they could have. So they had real estate, they had gold, and they had some insurance policies. Right, but really these modern financial products have come in now. The depth of the market also has happened over the last 20 years.
But even the real estate story, if I can take you back to that for a bit, coming back to India and looking at real estate prices kind of really puzzles me why people would buy property in this country. Because, I think back and, I own a house in California, that's a 3,500 square foot house. And its value is just about a little less than this 2,000 square foot little flat, 3-bedroom flat in a high-rise in Jayanagar that I occupy. And those numbers just don't compute.
And you said your house had a pool in California.
The house has a pool, and I don't have to worry about electricity bills and power cuts and everything else.
Yeah, that's right. So real estate again is this, it's this habit.
In India,
it's absurd. And also the problem with real estate, it's a clunky, messy asset. You need black money, you need all kinds of...
you cannot liquidate it necessarily as quickly as you might
want to. So there's a problem of liquidity. There's a problem of not being able to sell, say, a bathroom. When you need some of the money, you've got to sell the whole asset. Right? With equity, with mutual funds, you can sell a part and take out what you need. So real estate is difficult to get in, difficult to get out. There's a maintenance cost that nobody counts in. And there is this whole, what I worry about is that it's a problem of choice, location. So if I was an investor who bought in Gurgaon versus Faridabad, that has made the difference between me being very rich or averagely okay.
Over
20 years. Because it's really that one piece that you're buying and all the rest of the story happens around it.
And now, that is your biggest asset for most people. Right?
And so the whole problem of a tenant not leaving, of the house getting kabzad, of all of those problems with real estate, and then the kids will fight over it. Real estate is, in my opinion, it's a very poor asset, and the real numbers have never been done in terms of what is it that you really earn out of. People say, oh, you know what, I bought for 1 lakh and I'm getting 50 lakhs. But over what time period? You do the CAGR.
And what are the intervening costs?
What are the costs? So if you do a CAGR, it doesn't look any different. You have to give equity the same respect that you give real estate.
So now you're getting into my space.
Absolutely, always been there.
Okay, all right. So now you're getting into my space. So more about equity markets is what we should be talking to our audiences about now that they've done all of this.
That's right. More in equity market, we are getting nearer to the deeper end of the pool, but there's still lots to learn.
But they know how to swim now, I think.
They know how to swim.
Or if they've been listening to us, they do.
That's right.
I think, right.
So we are not going anywhere. Come back and join us for more.
Come back and join us for more.